Welcome to Beyond Data with Kaya. This is a podcast where we dive deep into the ideas shaping private markets and alternative investments today. I'm your host, my name is Kaya, and I am thrilled to speak today with Morgan Terigi, the CEO and founder of Incomlend. Morgan, welcome.
Thank you. Thanks for having me.
Just in terms of a bit of a background, Morgan, you founded Incomlend back in 2016 with your co-founder, and since the inception, you have financed more than 1.2 billion of invoices, and you are a global receivable financing marketplace. I understand that you've done business in more than 50 countries, which is extremely impressive. And also, I see from your background that you have had the entrepreneurial spirits in you since pretty early days. Despite your mechanical engineering background, you have founded companies all over Asia. Like I see Singapore, Malaysia, Bangladesh, Indonesia, China, Japan. So tell me more about your background and your experience. What brought you to this place?
Well, it's a mix of two things. My family has mostly an entrepreneur background. I would say just about everyone, except a few minor exceptions. So it's being an entrepreneur. I don't think it's something you learn in school. You have classes for being an entrepreneur, but I don't think it's something you learn. You have it or you don't. And it's not about having gone to the university or not. You see people that are extremely successful in China. They've never been to the university. So there's sort of that background that was a key element ever since I was a kid, where you see things differently because you have people that are constantly looking at opportunities and things that are set and carved in stone, which is very much a large corporate life that some people may lead. When you're looking at it with different eyes, it's sort of a street smart type of mentality. There's sort of survival instincts that you develop over time. And when you go to different countries, you see things with fresh eyes always. So that I think is really when you travel and you have that mindset, it's extremely stimulating because you see things differently, more than you would see in your own country. So that was pretty much my background. That's how I was brought up. I went to engineering school. I could have gotten kicked out of engineering school because I wanted to set up a company at that time. And I could see the teachers looking at me at one stage with my mind, thinking about other things. And I sort of stepped away from it because I wanted to get my engineering degree. I moved on to business school afterwards, HEC in Paris, where it was clear that it was about setting up a company, which is really not what large business schools bring you up to. They bring you up to be a good senior executive in a large corporate, having a high salary, where the entrepreneur is very different. You look for the excitement. It's different, and work is part of your life. So what I did when I started, I liked trading. I was very much into trading. I started in oil at the beginning, large groups. I didn't stay too long. Total, then Valorec and Steel. I found it interesting, but incredibly boring at the same time. I needed something new the whole time. And for me, business development was something I liked very much because you have a new strategy. You start from a blank sheet of paper with a customer, a new market, and you build it. And once you built it, it's sort of, well, you pass it on to other people and you want to move to something else. So that's what I was doing. I liked Asia. I was attracted by Asia ever since I was a little kid. China, probably had something when I was in kindergarten around China. According to my mom, I don't remember, but it stuck in my mind that I wanted to know more about China and Japan. So I moved to Japan after leaving the corporate world, and then I started looking for opportunities. So that took me to China, Japan, all of Asia pretty much, and Hong Kong, where I set up my first company. I think it was probably in 2002 or 2003. And things went from there. I looked at fundraising. I set up a language school in Tokyo in 2004, around that period of time. I helped companies as a consultant get into Japan. I helped companies get into China. I helped them source. Then I thought it was very interesting, coming from a trading background. Thought, okay, then let's do it myself. And gradually, I got into more and more volumes, and I got confronted to trade finance. That's how things got to where I am currently, really.
Wow, this is very, very interesting and natural background. I'm a big proponent of people trying their luck and trying their skills in different industries, and seems that you really are like a poster boy for trying things out and seeing if they work, if they don't. And I also like the fact that you have had experience in so many different countries, because many people look at Asia as one group. Actually, Asia is extremely diverse. We
Yeah.
talk about 60% of world's population living in this part of the world. The religions, the languages, the nuances, even within one country, are just immense. So you really have experienced and seen so many different verticals, layers, tiers of Asia, from hyper developed Singapore and Hong Kong to places like, for instance, Bangladesh and
Yeah.
Malaysia to some extent
Yeah.
back in the day.
Yes.
So
Yeah.
it's brilliant. But tell me, what led you to founding Incomlend? And as I mentioned before, Incomlend is a invoice financing marketplace that basically connects small, medium-sized enterprises, SMEs, to private credit investors.
Well, I saw Incomland as I saw my own businesses, really, and the frustration at times to getting access to financing, which was, in those days, it was really very much bank financing. You didn't have the alternative financing space that subsequently started growing since the mid 2010s. So the frustration around getting access to financing, not able to necessarily grow as fast as you would like to, because you're blocked by certain financial tools. I was very much used to using LCs, different forms, and so forth, to get the money flowing the whole time and avoiding to be in a situation where you're stuck. When I stepped into manufacturing when I was in Bangladesh, I mentioned I spent quite a few years in Bangladesh. I had my own factory. It was even worse, as I had to pledge so much assets for getting access to receivables financing back then. I thought it was silly. If you have the right customers and your customers are confirming the orders, I didn't see why I needed to pledge so much on top of it. So Incomlend was really much a product of that experience, and also my former business partner helped me realize back in 2014-15 that there were platforms that were being set up at that time in China where people were having access to a more flexible source of financing. So that's what led me to think about it. I was looking at it from an entrepreneur background, and looking at it with different pair of eyes, thinking, well, there are companies like Uber that are using technology and redoing something that's been existing for a long time, but putting a different twist and putting a little bit of marketing onto it. Maybe it could make sense. At the same time, helping people, connecting them with cash. And that has been the motto for Incomlend since the beginning, connecting cash. That's where it comes from.
Yeah, and that's such a great point, because even in Southeast Asia alone, there is more than 40 million small, medium-sized enterprises, or SMEs, which is about 51% of SMEs that are currently unserved or completely underserved by traditional financing. And I think the financing gap as of last year was something around 300 billion US dollars. So this is an immense market opportunity.
Yeah, absolutely, absolutely, and this has evolved over the time. I mean, you have your initial objective, and as you move along, you always have to remain very nimble, because things change, the environment changes, and God, it's changed a lot over the past 10 years. We've had COVID, we've had so many, and we're having more currently with the tariff wars. So it's you have to be very, very flexible, and you have to be sort of a chameleon the whole time and blend into that new environment and adjust things, not to be shy to change whatever needs to be changed to make it work. Where you had the SMEs that were, as you're rightly mentioning, that have a lack of access to financing, but you also have large corporates now more and more that are realizing that alternative financiers are also something that's very critical in their path for diversifying their own portfolios.
Absolutely, and it's often the alternative players that are faster to move, They have more tech-enabled solutions when it comes to KYC, underwriting, all of these things. So I think the market is definitely catching up in this part of the world as well, and I'm referring to Asia. I mean, I think we see more alternative financing, or have seen, in the US and in Europe. But coming to your point about the change in the market dynamics, I think the key word for 2025 is volatility. So let's talk a little bit about the investment landscape. Private credit markets have absolutely exploded. I think there's been tenfold growth since 2010, and the total size of private credit is about 2 trillion at this point. So what do you see from your perspective? What is the main driver of such explosive growth on the investor side, and also on the, let's call it the portfolio company side?
Well, I think indeed, like you're mentioning, it really has grown. I think we were around $300 billion back in 2008, which has grown to about $800 billion in 2018. We're currently probably at $3 trillion, and estimates hint that by 2028, we could be at $4 or $5 trillion. So the growth is definitely explosive. One of the elements has definitely been the regulatory landscape with banks, Basel III and so forth, where it has become more and more complicated. And this is how we came up with Incomlend at the beginning, because things were just too complicated and too cumbersome to have access to financing. So this is one of the elements, this huge pie that was predominantly dealt with by the banks has been crumbling, and you're having alternative financiers that are stepping in that space, using technology, having different products, being specialized in certain things, and also not following the same regulatory landscape as banks are. Like, for example, for Incomlend, we follow different rules than a bank does, because we're not a bank. So that provides a lot of opportunities. The banks scaling back has left a void for alternative financiers and private credit. That's one thing. I think it has been enhanced with the current macroeconomics, where we've seen a lot of changes for the past 10 years. And I would say, if we start from COVID, we've had things that were unheard of, unthinkable before. I remember when I got Sequoia on the cap table for Incomlend back in late 2019. I remember talking to them and saying, well, listen, I chose, and that was what I was thinking at that time, I chose trade finance, I chose the world trade, because I see it as something extremely stable. I don't think this is going to stop anytime soon, not in my lifetime. 6 months later, even less, COVID happened. I was like, well, I'm not going to keep my mouth shut.
The world economy was like, hold my beer. Let's just see what's going to happen now. Right. I'm going to prove you wrong.
and then after COVID, I mean, there were a series of events. You had the entire freight cost that went skyrocketing, interest rates and so forth. And then you're like, oh, we should be just about there. Then someone called Trump comes along and says tariffs all across the world, which is like, okay, now we're back to square one. There's another event. So you come more prepared. Back in COVID, it took us a year to face and readjust things. It was like a nuclear bomb for us. But then now we're a lot more nimble. So going back to your point, macroeconomics have changed a lot. There are changes that are more frequent. You get these shorter cycles that we were not getting back then. We had a period of time from 2000 to 2020 that was relatively stable. We had 2008, the economic crisis back then, where a lot of adjustments were done. But when you look at things the way they were done before that, interest rates were very low for a long period of time. It was a very safe period of time, very stable. Now it's different. So bank statement is stepping back. There is a void. New funds, private credit funds are stepping in, and that number has grown quite a bit. They were at 100 back in 2018. They're around 1,000 currently. So they have grown significantly, and you have some very large funds in there, BlackRock and so forth, that bring significant liquidity. So the macroeconomics, they're not shutting us away from opportunities or just generating more opportunities. Whenever you get a crisis, that's what they say in China. The word crisis in Chinese is an opportunity that's inside the word. So it does. Movements bring opportunities. And I was talking to Chinese lately, and they say, well, this is perfect now because the more changes you have, and if you're quick enough, the more money you make.
Right. And coming to the point around macro environment, as you rightfully point out, we've had such a long period of low income, low interest rates and low volatility, and also something called quantitative easing. So I would say there's a whole generation of market participants, such as myself, that haven't actually operated in an environment where you have significant cost of capital, or where you have low liquidity, or where you have high volatility. With your experience, background, and the number of conversations you have with investors now, how have things like high interest rates, liquidity, volatility reshaped the conversations around private credit in particular?
Well, it has brought a lot of opportunities because things that they would not have had access to at that time, and it goes both ways. You can look at it from an origination standpoint, and you could look at it from a funding standpoint. It has brought new opportunities. Of course, you have different strategies because private credit means a lot of different type of products: direct lending, senior secured loans. You can have unitranche loans, mezzanine debt, distressed debt, real estate debt, ESG, impact trade. So you're getting sort of a kitchen where, as an investor, you're seeing all these products and people that are specialized in these products, and you're having access to different. You can build a more interesting portfolio, I think, from that perspective. Definitely, the growth on interest rate and the fact that you have different products has enabled companies to have a finer access to pricing in a way as you're getting more competition, and you can play one fund or one hedge fund against the other. So you have these situations that go both ways, actually. And as an investor, an LP in these funds, obviously, then you have something to choose from where you can bring a portfolio with different liquidity and different risk factors. And whenever your macroeconomic environment changes, where it's something that's much more volatile currently, you have strategies out there that are more liquid than others, and time to reduce the risk because it is quite risky in the current situation.
Absolutely. And I like the point also having the, almost like a shopping cart full of different options, different funds. And it's sometimes a bit overwhelming because there is firstly the unlimited options, but also the limited information to see what's actually happening under the hood. And I think this is one of the let's call it issues or potential risks when it comes to private credit, is often having that limited visibility and also liquidity at the underlying asset level. But talking a little bit about volatility in this particular asset class, as of last year, private credit had fairly low volatility, or let's call it correlation with private markets, with public markets. It was about 3.7% volatility compared to all the public markets. Global equities had volatility of 19%, and high yield bonds had about 12% volatility. So how do you view the low correlation that private credit has to public markets? How important is that to institutional investors, especially in today's landscape?
Well, what's interesting in these products in the private credit space, especially when you look at trade finance, you're having things that are not correlated to financial markets. So it's an additional tool to bring, or product to bring in your portfolio to hedge yourself against these times when what we see are stable returns. Over the past 10 years, we've been consistently providing returns on high single-digit numbers to our investors. I mean, you have slight periods when it can get a little bit lower, a little bit higher, but not that much. In the end, it's not within 100 to 150 basis points. You're pretty much meeting similar returns over time, which is very interesting, which is totally uncorrelated with financial markets. So that is something where this is interesting, and it's a way to hedge yourself against this. Now, as you mentioned, indeed, the different structures, the fund structures, is not something where you're getting a full visibility on what's happening under the hood. You're having with platforms, fintechs, different types of vehicles where sometimes you can raise the hood and you can have full visibility on the entire portfolio, as opposed to a fund where you're only getting the top lines and it's commingled in the end. So you are sharing the risk with other investors, a little bit like an equity holder, which is a form of equity anyway in a fund.
Yeah. Yeah, and I guess coming to the point about having visibility, you have to pay a premium. You have to pay a premium effectively for visibility and for liquidity, and that probably translates into lower yields for certain products that offer that type of visibility. I mean, there are horror stories about private credit funds that maybe print their NAV only once a year, and then once a year, when the reporting comes, the investors realize that there is a very large percentage bad debts suddenly out of the blue, and hence the goods extend and pretend that you see in private credit. So I think the liquidity and visibility angle is really, really appreciated based on what I at least hear from different people I speak to.
And you're having complexity also around these products. These are, I mean, we talk about trade finance supply chain. That's why I emphasize, because this is what we're specialized in. But there are different ways of approaching trade finance, whether it's pre-shipment financing, post-shipment financing, disclosed or not. There are a lot of little details that change the risk profile entirely. Is it credit insured or not? How does the credit insurance mechanism work? How much protection do they get with this? So it's probably the negative point of this when you're opening the hood, is having a lot of complexity. And someone that may not be used to these types of products or trade finance in general, it may be a little bit overwhelming. So the funds help you simplify it by not having to make your own due diligence and really going into the nitty gritty of trade finance. But at the same time, like you're pointing out, you find out things. There are things where when it's not managed properly, you're getting your NAV at the end of the year. You're finding out, well, they're NPLs and how do we deal with them? And does the fund have experience dealing with the NPL or not? Are they doing the origination themselves or not? Which is not always clear. Maybe they're shopping around and they're following different risk policies by doing that. So there is risk and complexity around that, which is not for the average person.
Yeah. And coming to the point around the real economy, right? And you mentioned the type of financing that Incomlend does. So I like the real economy angle, because this is something people generally can understand, right? Like, this is where your money is going, financing a specific invoice, or maybe a specific good, or whatever the underlying actual product is. But can you tell me a little bit about why is it so critical for businesses to access liquidity through alternative financial solutions? And let's focus predominantly for small, medium-sized companies.
Well, the problem with bank financing, and that's what I was struggling with, or not, I was against when I was managing my trading firms and factories, was the fact that you need to bring collaterals to the table when you speak with a bank. So you have two options. If you're not having access to bank financing, you use your own capital to finance your receivables, for example. If you're having access to bank financing, you need to pledge your collaterals, which effectively I see it as doubling the rate. If a bank is providing you, say, an 8% cost of capital, they will want to pledge certain assets which you will not be able to use for other investments, and where you could be yielding 8% or more. So the cost of capital, the way I see it, is that with a bank is much more expensive than the number you actually see on the term sheet, because of the assets that are pledged, and it's blocking you from future developments. I'm talking from a receivables financing perspective, which is what we're doing at Incomlend. For example, the entire trade finance. This is one angle. The other angle is when you're using your own capital, it has limitations, but something that is providing you a return when you're financing your own trades at high single digits, when your IRR should be probably 20% and above, it doesn't really make sense. you might as well get that high single digit or even a low double digit cost of financing and maintain your capital to increase your developments. Maybe you need more a bigger factory, more machinery, and others. This is where I think factories or companies' own financing should be. That's where the balance sheet should be used. And when you're having access to a bank, this is where it's very expensive in the end, even though it doesn't seem like it, because you're pledging. You want more assets, but you're pledging the original assets. So it's limiting your growth. And in an environment currently where you need to be very nimble, it doesn't mean you necessarily would be investing because there is risk. But when you see an opportunity, you need to be very aggressive and very quick. These alternative private credit solutions enable you to move much faster, where a bank may take you a year for them to come back and make a decision. A private credit solution provider could come back within a month or 3 months, depending on the situation.
Yeah, and this is an opportunity cost that probably doesn't get discussed enough, right? Like everybody looks at the term sheet, they look at apples to oranges, and they try to draw some conclusions, but there is that same hidden opportunity cost. Firstly, that takes the time it takes for the bank to underwrite, and then the sort of pledge of assets that could be used to generate income on the other side.
Well, imagine a situation like we are currently. If a bank comes back to you even 6 months later, which is a very short period of time from their perspective, tariffs may have doubled.
Exactly, yeah.
Is no longer the same offer that you're needing or need at all, or maybe something happened the other way. In the end, tariffs were exempted. All of a sudden, no, you need to move very quickly.
Yeah. I wanted to ask a question about the biggest risks and opportunities, but you may have answered that. But I'm still going to ask, in general, global trade and private credit, where do you see the biggest risks? And maybe we'll leave the tariffs aside because that's an obvious one. But also tell me, where do you see the opportunities?
So it depends if you look at countries or if you look in general at countries. In Asia, things have moved around quite a bit over the past 10 years, where growth has shifted significantly from China to other Southeast Asian nations and South nations, such as India, for example, that has been pretty much consistently having a growth of GDP growth of 6 to 8%. Except for 2019, COVID, obviously, they had a 3-year period of time where it was lower, and 2020 was one of them. So what we're seeing currently in the environment is a shift in corridors, trade agreements, and this is where you want you want to have flexible solutions where you move from one jurisdiction. For example, Hong Kong, we see a lot of people that are in Hong Kong. And Hong Kong has its own risks, agreeing or disagreeing with China. That has having gone back into China, but people see it as being linked to China. So we see people having moved to Dubai quite a bit, where the UAE seems like the alternative to Southeast Asia, maybe stepping away from Singapore, tax-wise being more interesting, and having different trading hubs in Asia. But I think the opportunities are growing at a significant pace, especially now when we're seeing things that have been set and carved into stone for the past decades that are reconsidered entirely in a matter of a few days or weeks. A lot of things have been put into question, and you're seeing these changes in corridors. A lot of things going into India currently from Asia, a growth in volume. And at the same time, India has been able to provide a lot of transparency in terms of access to data, so that from a risk assessment perspective, it's extremely valuable. So that has enabled finance to the investment pace to have access and manage their risk at the same time. So both have been growing at the same time.
Yeah, I think one thing India has really done well is just generally leading with digitalization. And this is a big theme, in particular in Asia. People tend to be fairly tech savvy in this part of the world. You see a lot of fintechs emerging, and you see, I would say, a lot of those newer age technologies such as tokenization and AI-driven platforms being introduced in Asia. So how do you see this innovation reshaping how investors think about private credit?
Well, first of all, it's interesting the way we were looking at digitization, because digitization is the way we were using this 10 years ago. It was changing, for example, a physical document, an invoice, into a PDF. That was digitization 10 years ago. I mean, to put it very simply,
Yeah,
it
yeah,
is digitization.
yeah,
It's transforming a physical asset into a digital format. As more and more people were using these tools, as you were having access to more and more data, centralized data, custom points or other points in terms, and India is a perfect example with the imports of goods into India, and also the national ID and other things where you can really centralize. And I've seen the UAE also doing it with just
yeah,
your ID. You get access to all types of apps. Everything is interlinked. As you had more of this, AI stepped in, which was just, it was an overwhelming amount of data. You needed something to manage the data and analyze it. But then as you move down, we talked about tokenization. Tokenization is putting things onto blockchain, a token format, which ultimately is linking to access to financing. So you're getting sort of something that goes around where you're having tools that enable you to organize your information, which is important when you're analyzing risk as a private credit provider. You want to see where the data is coming from. You want it to be transparent. You're talking about blockchain, and you want it to be analyzed as accurately as possible. AI. I'm simplifying things, but this is how you're looking at it. And as you get something organized in the end, you put it in the format of tokens, where then tokens, you want to have access to liquidity. That's what the tokenization ultimately, that's to improve your access to liquidity. It may not be yet very efficient at that stage, but this is the next step that's going to happen.
yeah.
This is what we're going and we're heading for at a very high speed.
Yeah, this is something that I find one of the easier explainable, understandable use cases of let's call it real world assets or RWAs is how do you complement the private credit world, in particular trade finance, with the digitalization. And maybe you can just mention what is the most exciting part for you about the sort of amalgamation point of crypto markets, real world assets, and private credit and trade finance.
Well, I think the crypto markets have been experimenting, and you've seen a lot of meme coins in that space that honestly have no application whatsoever, no value. It's pure marketing. At the same time, it has helped throughout that time, and the crypto markets have gone through various cycles, ups and downs, as all markets do, and every time they come back stronger. The technology has become much stronger. It's very different from when we started, or I started on the side in 2018, when you had the ICOs. It's sort of a prehistoric age from what the way things are done now. Wallets have evolved in sophistication, and security layers are much stronger than they were back then. So that space, when you move down, you fast forward from 2018 till now. If you look at stable coins, where I find a lot of applications around that, the usage of stable coins, USDTs, USDCs, have gone from 2023, I think it was around $7 trillion in transactions worldwide. The following year, in 2024, it was estimated to be around $15 trillion. So that is evolving at a very high pace. So you're having the meme coins side that has helped work on the infrastructure, blockchain, different blockchains, tier ones, tier two, Ethereum, that's the most commonly used blockchain, stable coins that have been evolving quite a bit. We were talking about stable coins back, I remember, in 2018-19, but those were the early days. Things collapsed and grew again. Now we're looking at real world assets. And now what is interesting about real world assets is that the real world is Web 2. Crypto world is Web 3. This is a Web 2.5. So
Yeah.
this is something where you're bridging the two, where the main focus is really fundamentally to bring liquidity into the crypto space. So I see it as a need from the crypto space, Web3, to bring more liquidity from the real world. A lot of people do not know about crypto wallets, how to set up a crypto wallet and move cryptos around. This is the challenge at this stage. Now, the applications that we saw from a trade finance was for us to bring liquidity in that space and to benefit from that space at the same time by enhancing returns or reducing cost of capital. So, I mean, this is one application that we saw. I think there are a lot more applications, and people will find other ways of solving their own problems. But there's definitely something we're at a crossing point where two worlds that were evolving separately for a long period of time are now matching. The crypto world is anti-bank, anti-whatever. For me, it feels like you need the two worlds. You need your bank accounts, you need KYC, you need compliance. At the same time, for transactions, stable coins enable you to move much quicker. It's much cheaper, 24/7. So there is a tool around this that could challenge the entire SWIFT system at one stage, but it has its own problems as you're in the current stage where it is. It lacks transparency in terms of who owns the crypto wallets. But you are definitely seeing something where there is a merger of two worlds. I see Web 2.5 not as something that's away from Web 2 and Web 3, but something that is using the two worlds. That's how I see it. And this is the entire RWA space. I think this is the next crypto wave that is in the making currently, and will give way to the major leaders in the next couple of years or so.
Yeah, and I agree with your point that, as much as hype you have around meme coins, they do help with building out the infrastructure and effectively
Correct.
maturing the sort of industry or the vertical, if you will. And I think for those investors that are willing to do the research and see beyond the noise and actually dig deeper, then there are very big institutional companies building out these type of infrastructure, and you can again bridge two worlds like you rightfully point out, and also the whole new group of investors that are going to be brought in just because they don't want to deal with, let's call it traditional asset classes. They want to deal with crypto, they want to deal with digital assets,
Yeah.
and that really bridges that gap.
Yeah. Correct. It's a little bit like the dot-com bubble. If you look back in time, late 90s, website.
Pet.com.
People had a website. What do you do with a
Yeah.
website? There wasn't. It was just a window at that time.
Yeah.
Things collapsed. You always have two sides, two teams. The one team that was saying, "Oh, it was obvious. It was nonsense. It was just a hype," and the other side that is saying, "Well, wait, because you always have the first wave of companies that died because they
Yeah.
weren't strong enough, because they missed certain things, and you have the wave behind that adjust and become stronger." So it's a little bit military. First die, the second line gets stronger, dies, the third gets even stronger, and in the end, you get something. Well, you get Amazon, where
Yeah.
in the 90s, Amazon selling books, everyone was laughing. Well, you sell books on the internet. Why do you need them? But then their business model evolved. It's very different from what it was back then, which is normal.
Yeah.
Times evolved; they had to adjust, and now it's an incredible multi-billion-dollar company.
And it's the same point you make around being nimble and being able to adapt. And this is again coming to your entrepreneurial spirit as well, because I find entrepreneurs, if nothing else, they really are chameleons, right? They are adjusting, changing, through experience effectively. And people maybe that have been in their jobs for overly long time, they get too comfortable. And I think what really makes us, strong professionals is being comfortable with being uncomfortable.
Correct.
But as we're coming to the top of the hour, Morgan, there are a few questions I want to ask from all of my guests. And this is just to give listeners a bit more insights about you. Who are you as a person? So my first question to you is, what is the biggest professional mistake you've made, and how did it shape the way you're doing business today?
I think it was the first company I set up. I was in Tokyo 20 years ago, and I raised funds for the first time, setting up a language school. We didn't have the technology, but we were making curriculums, a different approach on learning languages. And we had raised, I think, about $1 million, or maybe a little more than $1 million back then. First time, first experience. I was super happy. And one of the major investments, and we had pitched that to the investors, they were all on board, was to have a large billboard on the building, on top of our building in Tokyo, in Shinjuku area, where we thought, this is it. This is going to bring the customers. We invest in marketing. Marketing equals customers. In a sense where very quickly you would get the customers. We failed massively. It brought no one. we ended up having to go in the streets like the Japanese and to bring the customers on to the school one by one. So I think that was something where, I mean, you get scared. You come across these situations where you have your business plan and things don't happen as you had planned. It's Murphy's Law. You have to expect it. Excel is one thing. Reality is another one. And that was one case. I think we may have burnt back then, or it was probably 25% or 30% of what we had raised. It was a significant amount. We were smack downtown of Tokyo, and that huge billboard, I remember it's huge. You could see it from a long distance away. We're like, this is it. This is us. We're here. Come. Nope. No one can.
Oh, I can imagine. I can imagine to paying 30% of your raise.
I always
But you learn,
back then, but yeah, you make mistakes.
But you make mistakes, and that's okay, right?
Yeah. As long as it doesn't jeopardize the company, it could have. You turn things around. You have to find solutions very quickly.
Yeah. And I really appreciate this margin of error principle. And I think it was Warren Buffett who talks about operating with a margin of error. Like, you can make mistakes, but just make sure that the mistakes don't kill you. And I think that's
correct. And I would say, if you don't make mistakes, ask yourself, because there may be a problem. You may not be learning. Taking risk is like an investment. You need to take a little bit of risk, and not everything will be successful, but you learn in that. That's what makes you stronger. But it cannot kill you. That's the thing. What doesn't kill you makes you stronger.
Yeah, that's the theory, at least. Morgan, tell me, who has been the toughest boss or mentor you have had? And tell me also one lesson that has stuck with you.
Well, I haven't had a lot of bosses. Obviously, I started very quickly.
Exactly. So. That's the problem. But at least a mentor. Tell me.
No, but I did have. Yeah. I mean, I did a lot of internships when I was in engineering school and business school, where I was a little bit worried at the end of school, where I was like, I did tons of internships in multiple companies, like Carrefour and a whole list. And every time I was coming out of these things, I said, oh, definitely not for me. And when you're graduating, normally the internships are made to help you find what you want to work, what industry you want to work in, and what company ideally, and you follow up on that. So at the end of school, I wanted to do trading, and I went to Total. And my boss was very strict back then, significantly older than me. So I saw it as sort of, I would say, a mentor in a way, because he had a lot of gray hair, and I had none, obviously, in my early 20s. And I remember one thing that he told me, because he said, son, make sure, because I rely on you on these transactions for you to get the documentation in order and making sure the deals happen. That friend that you're having, or you think you're having a friend on the other side, tomorrow you will be stepping in court, and you will have to fight against them to protect the company. So make sure you get everything in writing now. In other words, you reverse engineer your entire process. And that's something I still remember to date. And that's something I told in Incomlend when I started Incomlend 10 years ago. I told people, you have to put yourself in a situation where that customer, you will go to court against them. You will have to sue them, and you will have to recover the investor's money ultimately. I think it served us well, because we managed to get everything back every time we went into litigation, but that's because everything was in order. Think of it from a reverse engineering standpoint, and you're in that litigation stance. What would the judge ask you to provide in terms of evidence to make sure that you're on a winning position?
Yeah, that's a really good point. And I remember reflecting back on my own corporate days when I was working with Bank of America Merrill Lynch. One of the things that was always told us when we were doing our corporate communication courses was that always think that your emails or messages will be read in court one day.
Correct.
And that's something that has stuck with me as well. So when you said that, that really resonated, because I always think about that when I put something in writing. What are the things that I should highlight? Like, is there something that is understood by both parties but not explicitly mentioned? Maybe it's worthwhile explicitly mentioning it just in case, you know, something goes wrong at some point. And it may not be the person, it may be the situation itself changes, like maybe tariffs are being introduced or anything of that crazy nature. My third and the last question to you, Morgan, is that what is a belief that you once held about markets or investing that has completely changed as of now?
Well, I remember in business school when we were doing market finance, where we were doing portfolio analysis, and you build your portfolio, and you have your U.S. bonds in there, giving you a sure return of 5%, and that's the thing where nothing can go wrong, right? And you're thinking in your portfolio, there's things where it's a sure thing, it's a sure bet, nothing can happen. Well, we had 2008 with the Lehman Brothers case, and we had COVID, where I was telling you, Sequoia came in. I told them, well, I'm in a sure thing because global trade, nothing can go wrong, right? Volumes keep flowing. You're still going to need your containers of rice and so forth. So nothing will stop, nothing. 6 months later, less than that, everything was brought to a standstill. So I think the thought of they're sure things, they're sure bets, there are none.
Yeah, that's definitely a lesson, and I have to reflect again on my own experience on my own portfolio. No, I had a conversation with a portfolio manager, I would say probably around 2019, and this was senior portfolio manager doing scenario analysis and multi-assets. We talk about credit, we talk about equities, and one of the assumptions that was baked in, and it was hard-coded, was the interest rate level. What do you reckon that particular portfolio manager had baked into the ceiling of the interest rate?
What year was that in?
2019, I think, 2018, 2019.
Oh, they must have been very low.
It was around 1.5%.
Correct, right. Which
So
was,
yeah. So that was the top, that was the absolute ceiling in his view. So coming to your point, there's nothing certain in the markets.
Yes. No
Fantastic.
telling.
Morgan, it's been a fascinating conversation. Thank you so much for telling to the world about Incomlend and educating me a bit more about the business as well. For a compliance disclaimer, I am an affiliate of Incomlend Capital based in Singapore. But my conversation with Morgan today has been riveting, and thank you again for your time.
Thanks, Kaya. It was a pleasure.